Let's talk about a question that probably keeps a lot of people up at night. Why do so many people, we're talking a huge majority, actually lose money in the stock market? It's a pretty wild number. And today, we're going to dive deep into the hidden traps and the psychological games our minds play that cause this. And more importantly, we're going to lay out how you can join the 10% who actually win. Let's get right into it.
So yeah, this is the number. It's a harsh reality, and it's backed up by decades and decades of data. Something like 90% of individual investors either lose money or they do so poorly that, honestly, they would have been better off just sticking their cash in a high-yield savings account. Just think about that. All that time, all that stress, for basically nothing.
So, what gives? How can the single greatest wealth creation machine in the history of the world be a total money pit for so many people? That's the puzzle we are going to solve together today.
This chart tells a story, and it is a powerful one. Over a 30-year stretch, the S&P 500 market index delivered an average of over 10% a year. Pretty great, right? But the average investor, they got a measly 3.6%. That isn't just a gap, you know? It's a giant chasm where dreams of financial freedom just disappear.
Okay, so here's our game plan. We're going to dig into the 3 biggest traps that cause this massive underperformance. First, our own emotions. Second, a critical knowledge gap. And third, these hidden costs that just silently eat away at your money. Then we'll wrap it all up with a clear, actionable framework for how you can join that successful 10%. All right, trap number 1. And honestly, this is the big one. The single biggest obstacle to your success as an investor isn't some Wall Street shark. It's the person you see in the mirror. It's your own brain. The same gut instincts that kept our ancestors alive are, unfortunately, a huge liability in the modern market. I mean, just look at the 2008 financial crisis. It's like a perfect case study in how emotions destroy wealth. At the absolute peak of the market in 2007, everybody was euphoric, right? Retail investors were piling in left and right. And then, the crash. By the time the market hit rock bottom in March of 2009, when stocks were literally on a fire sale, those same investors were selling everything in a complete panic. They did the exact opposite of what you're supposed to do. They bought high and sold low. It's the cardinal sin of investing.
And what were the pros doing while all this was going on? Well, everybody was running for the exits, screaming. Investors like Warren Buffett were calmly stepping in and buying up billions of dollars worth of fantastic companies at historic discounts. They saw fear as an opportunity, not as a signal to sell.
Now, this isn't just bad luck. It is literally human nature. You have these powerful psychological forces at play. There's loss aversion, which is that feeling where a loss just hurts way more than an equivalent gain feels good. There's FOMO, the fear of missing out, that voice in your head that screams at you to buy a stock that's already gone up a ton. And of course, there's just pure panic selling. The trick is to know these biases exist so you can actually control them.
Okay, let's move on to the second trap because this really builds on the first one. This is all about a fundamental misunderstanding of what you're even doing when you click that buy button. Most people, they're buying ticker symbols. They're not buying businesses.
Think about it this way. Are you investing because you saw the price chart go up and to the right, fueled by hype on social media? Or are you investing because you actually understand the business behind the ticker, its revenue, its cash flow, its plan for growth? The 90% of people who lose money, they are laser focused on the left side of the screen. The 10% who win, they live and breathe on the right. And if you're looking at these terms and they feel a little foreign, hey, don't worry, you are definitely not alone. But it's also a big red flag that you might be playing a game without knowing the rules. I mean, the income statement tells you if a company is making money. The balance sheet tells you what it owns versus what it owes. Investing without understanding this stuff, it's like trying to fly a jumbo jet without a pilot's license. It's just a recipe for a crash.
The third trap is a little more subtle, but it is just as deadly. These are what I call the silent killers, the things that slowly bleed your account dry. Often, you don't even notice it's happening until it's way too late. I'm talking about hidden costs. It's one of the great ironies of the modern market. The more you trade, the less you tend to make. Even with all those zero commission apps, you're still paying. You pay in bid-ask spreads, which is that tiny difference between the buy and sell price. You pay in bad execution. And of course, you pay in taxes. All of that stuff can add up to a 6 to 10% drag on your portfolio every single year.
Let me show you what that really means.
Let's say you invest $10,000 and you get a solid 10% return. After 30 years of compounding, you'd have about 174,000 bucks. Not bad, right? That is the magic of compounding at work.
But now, watch what happens. If those hidden costs cut your return in half, down to just 5%, that same $10,000, it only grows to about $43,000. That is over $130,000 in wealth that just vanished into thin air, all because of overtrading. It is a silent killer of your financial future.
And then there's the ultimate account killer, leverage. Using borrowed money, whether it's margin, options, whatever, it's like pouring jet fuel on a fire. Yeah, it feels amazing when you're right, but it magnifies your mistakes so fast that you can literally wipe out your entire account before you even have a chance to figure out what you did wrong. And the math of recovering from a big loss? It's just brutal. It's not intuitive at all. If you lose 50% of your money, you don't need a 50% gain to get even. No, you need a 100% gain just to get back to where you started. A 90% loss, you need a 900% return. With leverage, you can dig a hole so deep that you'll just never climb out. Okay, so we've looked at all the traps. I know, it's a little scary. But now for the good part. How do we avoid them? How do we flip the script and actually join that small group of people who make money consistently? It all starts with a fundamental shift in how you see the world. First, we have to redefine what the stock market even is. It's not a casino. It's not a video game. It's a system. It's a system that is perfectly designed to transfer wealth. It takes money from people who are impatient, uninformed, and emotional, and it gives it to people who are patient, informed, and disciplined. Your job is simply to decide which side of that transfer you want to be on. So, how do you get on the right side? Here's the playbook. Number 1, become a business analyst, not just a stock picker. 2, create a system of rules for yourself to keep your emotions from taking over. 3, embrace the power of doing nothing. Trade less, not more. 4, just stay away from leverage until you truly master the basics. And finally, the golden rule. Protect your capital first, always. Chasing those quick profits is what gets the 90% into trouble every single time. In the end, it really all boils down to this. Hope is not an investment strategy. The market is a cold, calculating machine. It doesn't care about your feelings. It only rewards 3 things: discipline, data, and patience. It's definitely a challenging path, but the rewards for getting it right are immense. So the only real question left is, are you willing to walk it?